Options trading is subject to specific tax rules and regulatory guidelines that traders must understand to avoid compliance issues and optimize their tax efficiency. This module covers how options are taxed, key regulations affecting traders, and best practices for record keeping and compliance. Note this is not a tax advice, seek a tax professional for advice. Taxation of options trading. Tax treatment varies depending on the type of option trade and holding period. Below are the key tax rules traders need to be aware of. Tax treatment of equity options, short-term versus long-term capital gains. If an option is held for less than 1 year, profits are taxed as short-term capital gains, which are taxed at ordinary income rates. If an option is held for more than 1 year, it qualifies for long-term capital gains, which have lower tax rates. Expired options. If an option expires worthless, the premium paid is considered a capital loss. If a sold option expires worthless, the premium received is considered a capital gain. Exercised options. If a trader exercises a call option and buys the underlying stock, the cost basis includes the premium paid. If a put option is exercised, the sale price of the stock includes the premium received. Tax treatment of different options strategies. Covered calls. If the stock is called away, sold, due to assignment, the gain or loss is based on the adjusted cost basis of the stock. If the option expires worthless, the premium received is taxed as a short-term gain. Cash secured puts. If assigned, the purchase price of the stock is adjusted for the premium received. If the put expires, the premium is a taxable short-term gain. Spreads and multi-leg trades. Gains and losses from spreads are usually netted together and taxed based on the holding period of each leg. The 60/40th rule for index options. Certain broad-based index options, like SPX, NDX, RUT, are classified as Section 1256 contracts under U.S. tax law. These options receive 60/40th tax treatment. 60% of gains are taxed as long-term capital gains, lower tax rate. 40% of gains are taxed as short-term capital gains, higher tax rate. This can be advantageous compared to stock options, which are fully taxed as short-term gains if held for less than a year. Regulatory considerations for options traders. Options trading is regulated by various financial authorities to ensure fair practices and protect investors. Key regulatory aspects include Pattern Day Trader (PDT) rule. Traders who make 4 or more day trades in a 5-day period using a margin account must maintain a minimum balance of $25,000. Violating the PDT rule can result in account restrictions. Margin requirements for options. Brokers have specific margin requirements for different option strategies. Selling naked options requires higher margin than defined risk strategies like spreads. Options trading levels. Brokers assign trading levels based on an investor's experience and financial situation. Level 1. Covered calls and cash secured puts. Level 2. Buying calls and puts. Level 3. Spreads. Level 4. Naked options selling. Level 5. Advanced strategies like uncovered puts and ratio spreads. Record keeping and reporting for tax efficiency. To stay compliant and optimize tax filing, traders should maintain accurate records, trade logs, keep detailed records of all trades, including entry and exit prices, trade size, and timestamps. Profit and loss statements. Many brokers provide annual tax documents summarizing total gains and losses. Form 8949 and Schedule D, U.S. traders. These IRS forms report capital gains and losses from trading. Mark-to-market, MTM, accounting. Some full-time traders elect MTM status to deduct trading losses as business expenses. Tax-saving strategies for options traders. Use tax-advantaged accounts. Trading options in a Roth IRA or traditional IRA can defer or eliminate capital gains taxes. Harvest losses. If losses occur, traders can offset them against gains to reduce taxable income. Strategic holding periods. Holding qualifying options for over a year reduces tax rates on profits. Professional tax advice. Working with a tax accountant who specializes in trading ensures compliance and tax efficiency. Understanding the tax and regulatory implications of options trading helps traders minimize their tax burden, remain compliant, and maximize after-tax returns. Thanks for watching. Please like, share and subscribe. See you in the next module.